Are you worried about the recent market correction? You are not alone. Investors are wondering, should I invest, hold, or redeem my mutual fund investments? Should I continue my SIPs or stop them? Here is the truth. No one can predict when a correction will happen, how severe it will be, or how long recovery will take. But one thing is certain. Correction is temporary and growth is permanent. Take a look at history. During the dot-com bubble, Nifty fell 52% in 19 months, but recovered 106% in just 2.3 years. In the Lehman crisis of 2008, Nifty plummeted 59% in 10 months, but soared 143% in the next 2 years. In FY 2015-16, Nifty dropped 22% in 4 months, but regained 28% in 13 months. And during COVID-19, Nifty fell 35% in 2.5 months, yet bounced back by 54% in just 7 months. If we could time travel, wouldn't we all invest more during past corrections? But fear holds us back. Instead of panicking, stay invested, continue your SIPs, and even add more. Because for disciplined long-term investors, equity mutual funds turn market corrections into wealth-building opportunities. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.